Let's go to the trading floor in Chicago, shall we, and find out what the mood is among the traders there. We have Scott Gecas of Walsh Trading joining us right now. So I haven't seen markets this quiet in quite a while here.
Yeah, it's been very quiet. Volume is really light. It needs to be noted, though, even with this volume so light and pretty much a sideways market for the last few days, the option volatility is relatively high. And the reason why it's relatively high is because you have pretty much all the funds, all the traders are pretty much net short. So the reason why the volatility is high is if we get any positive news, you're going to see a very fast and sharp reaction to the upside just due to short covering. And that short covering could last for a few days. So we're definitely keeping an eye on that. We're looking at this certain technical levels, bullish or bearish above those levels. For soybeans, it's going to be 900 even, or 9 cents. For corn, it's going to be that 360 level. So we're going to keep an eye on that. But for as far as the option skew goes, you're going to see a little bit more volatility in the upside calls, a little bit more premium. You're going to pay a little bit more for upside calls rather than downside puts.
Okay, if you don't mind, we'll kind of put a stop to it right there, and then I want to bring you back and talk about the turnaround we have seen in this livestock trade today as well. We started out everything lower, and last check we had everything turning higher. So we'll check on that once again when we take a look at our livestock trade in just a moment. So our guest is Scott Gecas. Don't go anywhere. We'll be right back. I want to go back to Scott Gecas. He's at the edge of the trading floor in Chicago, and he's been talking with the analysts, of course, and traders around the trading floor. There's a lot of talk about the value of the dollar here today. You said that there were some numbers that came out from J.P. Morgan this morning that were pretty encouraging on the financial sector anyway.
Yeah, the J.P. Morgan earnings are starting to lead the way to earnings season with the positive earnings that they had. That's one of the reasons why you have this big rally in the stocks right now.
Okay, now I want to take a look at our livestock trade, and maybe this is all tied together. I don't know. The Dow, I just looked, and the Dow Jones Industrial Average is up about 235 points, I believe. Let's take a look at what the cattle and hog markets are doing right now, and sometimes they can have a relationship to the equities. Right now in the live cattle, you have your June contract 58 higher. We're at 121 even per hundredweight, and that's after trading as low as 120.05 right after the open. We're within 15 cents of our high of the day right now. So we currently have the August contract now at 117.95, and that is up 58 cents on the day. That's exactly $1 off of its earlier low this morning. Quite a turnaround there at midday. Now let's take a look at what's going on in the feeder cattle market. On the feeders, so far we currently have the May contract 30 higher at 150.15 now. So it's been kind of a tug of war at that 150 level there. And if we take a look at what's going on in the August, we're 70 higher at 158.35. That puts us within 15 cents of our high of the day there. Then you have the lean hogs, and they really had a turnaround here in this last half hour. Now we are trading mixed on the hogs. We have May currently 38 higher. We're at 88.78. And now you have June down a dime at 97.60. But that is still $2.50 off of its earlier low this morning. July down 15 at $100.85. Some folks, when they talk about this lean hog trade, they refer to it as like touching a hot stove. They don't want to get too close to that thing.
Yeah, for sure. Now, it needs to be noted, especially with the lean hog market, that we had the weekly exports come in, that China still continues to buy U.S. pork, even with the high tariffs. You know, I think, though, the record of weekly exports from the U.S. was roughly around 32,000 tons. One of the numbers we were looking at is about 91,000 tons just to China alone. So that completely has blown everything out of the water. That's one of the reasons why you're seeing a stronger rally in the hog market. It also needs to be noted that the current volatility in the May options is pricing in a little over an $8 move. What that means, and that's really significant, because if you throw in the limits, you have $3 limits, and even with extended limits, it's still not that $8 price. So we have an $8 expected move between now and May expiration. So volatility is at extremely high. You're seeing both sides of trade. You know, a lot of calls, a lot of puts. No one really has any idea which way this is going. That's one of the reasons for the expensive volatility.
You know, you were talking about when the market goes into that expanded limit mode, has that chased a lot of players out of the market at this point?
Well, I'm glad you brought that up. So all week I've been talking about the lean hog market as far as is what is coming in through the news. Now, because of the drastic move in the lean hog market for over the last couple of weeks, you're seeing players that are not normally in the lean hog market. A lot of equity guys are starting to write about lean hogs, saying it's a great opportunity to the upside. You're seeing a lot more volume come in. People that are not necessarily just playing with a hedging strategy, they're just more speculative. You're seeing an increase in volume, especially when we have these upsides. Traders are clearly buying the dips.
All right, excellent information, and best wishes for a great weekend there, Scott. I always enjoy talking with you about the markets. Scott Gecas of Walsh Trading Incorporated. He's right there in Chicago. Lots of dynamic action going on in the livestock trade. It's probably going to continue.
Okay, thank you very much, Marlon.
You bet.